Hello, everyone. Welcome to Lana Talks. We're back in season 3, actually. It's been a long time. And today we have a special guest. How are you doing, Nicola?
Hello, guys. My name is Nikola Jokic. Not the NBA basketball player, but almost.
Not to get confused.
not to get confused, right? Yeah, I'm honored to be here today. Thank you for having me.
Yeah, it's great that you could come, actually. So Nicola and I, we've been together since like last year at the how's it called, the Francisco Economy 3. So it's like business administration course package for writing the thesis, I could say.
Yeah, derivatives, empirical finance, bachelor thesis course.
Exact courses.
Yeah,
exactly. So we were together doing like the courses of empirical finance, financial introduction to financial derivatives, and then what was the bachelor thesis in finance. 1 year. That was on time, actually.
Yeah, hasn't been only that.
It's been 1 year. Yeah.
Then, yeah, I'm moving fast.
Yeah. And at that time, I had a very exciting podcast, and I remember that we were speaking about wow, you should come over and speak about financial derivatives at some point.
And it took us 1 year to get here. We already spoke of it March last year. Exactly 1 year ago.
Yeah.
Cool.
I mean, that's usually how it is. It's very tough to find times that suit everyone for recording. So it's one of the consequences.
Yeah. But they have a saying, when you wait for something good, you wait for a long time, right?
Yeah, that's true. So we're coming with a very big episode. I haven't spoken in this podcast about financial derivatives since exactly 1 year, probably. And it was in Spanish. It was the time where the podcast was all in Spanish. And I kind of gave an introduction to financial derivatives, and most specifically in options. So we're going to try to introduce, again, financial derivatives, this time in English.
Exactly.
Give an explication, a definition that is suitable for the very beginners. And most importantly, and the biggest reason for you to be here is because you wrote your bachelor thesis about financial derivatives, right?
True. After taking the Introduction to Financial Derivatives course last year, I actually had no idea of what to write about in a bachelor thesis, but when I took the course, I actually wow, I felt like this is the thing to do. And so I found a partner for writing the bachelor thesis together with, and we came in contact with the Nasdaq here in Stockholm, Sweden. And they gave us this task, so we collaborated with them to write a thesis about the use of financial derivatives in Swedish equity funds. And our title of our thesis, just so that you know, if you want to look it up, is "The Uncharted Use of Financial Derivatives in Swedish Equity Funds," written by Johan Lind and Nikola.
So it's very interesting.
Yeah, it was.
Here's the thing. When you write about your thesis, especially when you write it with a company, you usually have I would say that is an extra job from what I've heard of other people. How was the experience with Nasdaq in this case?
It was good. We had a few meetings with them before starting to write his thesis, and we talked about the market, the financial derivatives, about how it looks in the Swedish market, And then we came to an agreement to write about this thesis. And of course, whenever we felt that like we were a bit lost or we needed some help, they were there answering our questions. So it was a pretty decent, pretty good collaboration, I would say. We didn't have any like some companies, they do have like, they give you like an internship, right? Like an internship kind of, yeah. This was more just like an task from Nasdaq, and like just helping us if we need something. But we very much appreciated it as well, of course.
You were working as associates with them? Something like that? Like we're not part of we're not really like part of NASA, but we're like partnering with them to get like this thesis out.
Yeah, exactly. Yeah, just like partners. Yeah. So we do the thesis. They gave us the task and then some material to work with. So yeah.
For someone that is interested on doing similar research, how in advance would you say that you have to contact with such a big institution as NAFTA the case, right?
Mm-hmm.
What would you say? That's maybe I heard of people doing it like the term before writing the thesis, or how many months in advance do you think it should be?
I mean, if you want to get in contact and to get some collaboration or writing the thesis as an internship or as a job for in a big company, you should definitely write like 6 months, at least 3 or 4 months before the thesis. We were kind of very close to. We contacted the head of derivatives on Nasdaq like probably only 1 month before. So it was really tight, but we were lucky to get that opportunity to write the thesis in collaboration with Nasdaq, which we're very thankful, of course, for. The funny thing is that we had like no idea. Me and Yuan, we were sitting like in the financial derivatives class, and like people were already talking about what they're writing the thesis about. We were like, what are we gonna write it about? We were both really interested in derivatives, so we had the representative from Nasdaq who held the lecture at the SU during our course, and then I reached out to him and he gave me the contact of the head of derivatives at Nasdaq. Yeah.
So that's great, actually.
Yeah.
Also glad you get like the initiative and the possibility to do it with a firm, which is with an institution, which is like very complicated.
Yeah, it is. Yeah.
How does Nasdaq really work as a financial institution? Like, Nasdaq is somehow it's for someone that has like no clue. Because, would you say that is like the point of like the middle like a person, like the middle actor that like sells or like buys or gives like this like place where two traders can like join with each other to like sell and buy what they have?
Yeah, and I think you described it perfectly. Like, if you ask me like what the institution was, the company actually working with, I guess they have like of course the thing you said, and but also like approving investment banks that want to like start a new fund, like for example small income funds or like low interest funds, That kind of they have to like approve and so the funds can enter the Nasdaq family, and then you can trade the funds at the Nasdaq.
What would you say? I don't know. You have like I think one time I asked you about this because I don't really know about it. What is the difference between a hedge fund and an investment fund, for example, like a fund that belongs to like an investment bank?
So a hedge fund, they use derivatives to kind of position themselves in order to either speculate on some on prices of, for example, stocks or commodities, or to hedge risk, but also to amplify exposure. And they use like financial derivatives such as futures, forwards, options. Some use swaps as well. This kind of instruments. Meanwhile, you have also like mutual funds, and they can also invest if they have the right for it. They can also invest in derivatives, but they are more focused, usually more focused on like investing in stocks, whether it be like I don't know, small cap stocks or large cap or value stocks or growth stocks. They can invest in index such as S&P 500 or OMXS30, the Swedish one.
Just technically, it's easier to invest in stocks than it is in derivatives, because for derivatives, if not used properly, you can like get exposed to incredible risk, right?
I wouldn't say it's easier to invest in stocks than it is in derivatives. That's just kind of some like
misconception that people
a conception that people have, because I don't know, maybe like the financial crisis of 2008, 2007, and then everything that happened with options and stuff, like people lost a lot of money, wealth managers and so on. I think investing in stocks is kind of easy. You can follow whatever everybody else is doing, right? But also, if you want to make money in a short time of period, it's very hard. You can do day trading, for example, yes, but it takes a lot of time, a lot of effort as well. People also usually say that like using derivatives, trading in derivatives is more riskier than trading in stocks. Yes, maybe it is a bit riskier, but if you have the knowledge, if you educate yourself enough, then I would say that you can make more out of it with derivatives than with stocks. You just have to be very good at analyzing the macro situation in the world, how prices are moving in different branches like technology, AI, how it's moving with like situation in the world with wars, how that affects prices of different commodities like wheat, oil, the transport routes, what happens to them when there is a uncertain balance or situation in the world, what happens to inflation, and use that knowledge to implement it on derivatives and gain profit from it.
Sure.
That's the for example, if I can interrupt you, like I know when the everything that happened in Ukraine, when it started, I know that for example, a lot of how do you say in English, like defense and defense stocks, like the ones making weapons.
Yeah, I would say
Sure, yeah. Oh, yeah, weapon makers, like, I don't know, like Saab, Boeing, Lockheed, all these companies that have stocks that are public companies. I know they gained a lot profit from it, for example, and the stocks increased like immediately as soon as the things, the shit happened,
And that the thing with the derivatives also is that when I first was hearing about this during our courses, I realized that it opens you like such a vast world of opportunities in investment. In investing, like we're taking many different positions, as you said, like position for like hedging risk, and like minimizing the risk, and like many different possibilities, even for the one that wants to play the gambler. So you can also take like bigger risk. Then it depends on like how analytical you are to understand if this risk is more worth it or not, depending on the returns that you're expected to get, right? But that's the crazy thing about derivatives. Now, for someone that has zero knowledge about everything that we're saying, like stocks, derivatives, options that we have also mentioned, from the very basic, the market economy, are basically like the stock market. How does it really work? What are stocks for someone that has like no idea? How can we like define this?
So to begin with, stocks are, well, how to describe it in English? Stocks could be described by like,
so for example, when you see the stocks in the stocks that are like out in the stock market for like anyone to buy in public, it's basically the company issuing these stocks in order for people to buy them and for them to get like money so they can invest it inside the company.
Yeah. So basically it's like just an asset that companies go public with for the public to be able to buy a share of the company, and if this share that you buy, if it increases, then your stocks increase. If it decreases, then of course your stock decreases as well. So it all depends. So the stocks of a company depends on how the company is doing, based on different various factors.
And here's the thing: it does not always depend on how the company is doing. In some cases, it can be inflated by the expectations of this company. Like, let's say that they present Facebook when they presented Meta, their stocks went all up because people were expecting a whole like revolution.
Mm-hmm.
Maybe what was really behind this Meta wasn't really a revolution. It was just like another simple product that came out. For now, it hasn't really like showed that it has like the capacity of being some sort of technological revolution yet. Maybe it takes like more time, or maybe it was just some strategy to inflate the stock prices, who knows. But at the end, there's a big part of it. It's about the company's expectations and what people expect from them. So also other stuff that can affect is many people that buy or big corporations that buy like these stocks, prices go up. People buy it more because they think that they're going to go up, expecting they go up. Prices go up too. The big corporations, for example, sell it, or like huge big amounts of people like sell stocks. Prices go down because people expect that the prices are also going to go down. Yeah. Doesn't mean that the company is like really doing, it doesn't have to be that the company is like really doing bad. Yeah. It's more about also a big part of it, what people expect from it. And that's a crazy thing. And then from stocks, it doesn't have to be stocks, but derivatives basically are these financial instruments which or whose value derive from other commodities, right?
Yeah, derivatives value comes from different commodities, like you said, like oil, gas, wheat, gold, silver, like everything, basically, but also stocks. So you can buy derivatives like futures in a stock. The thing with derivatives is that, like with stocks, when you buy a stock, you actually buy it immediately, and it's yours. When you buy a derivative or go into a contract, better said, derivative. So if you have a derivative that you want to buy, that's in like stocks, for example, a Tesla stock, you're gonna go into the contract of buying the actual stock in a couple of months. It can be 3 months or 6 months. And that's called a future. So you're not buying the actual stock right now, but you have decided a certain price, a fixed price for the derivative, and in the upcoming, after 3 months at the maturity date, you can choose to buy, to exercise the derivative, or sell it.
That's if it's an option, or does it also work with futures?
It works with futures that, I mean, you can choose to buy it,
okay,
and then sell it, of course.
Oh yes,
Sell it forward, sell it forward,
I think that the teacher, when we were taking the financial derivatives course, gave an example of like this guy that's bought for like speculating in the price of the future itself. So this guy wanted to like trade futures. He bought some futures in cattle, I think it's called. So like cows and all this, like cows basically. And he was supposed to like sell it, but he couldn't sell it. I don't actually remember exactly why, but for some reason he couldn't sell this future. And what happens when this future is exercised at the end, like you have no way to sell it or anything, that the whole cows, transport your cows, comes all the way to like this guy's house, and he has like the whole house full of cows. Like, what the hell am I gonna do with all this? I don't think he really understood what's a future does. Yeah. Like he was doing it for trading, because like the same as it can work with some, it can also go forwards. It was a forward It was a forward contract, exactly. Which like you have like the obligation to like receive it.
To receive it, yeah.
You can't like say no anyway.
Yeah.
And the guy just received it, and he couldn't find anyone to sell it at the last minute. And he just got his house full of cattle. Bro, it's terrible, actually.
You got a lot of milk, at least.
Yeah, they got some of the milk. Oh, man.
Yeah, just to explain, like, the definition of futures in a better way, like, so if you go into a contract today to buy a future in 3 months, you have decided a price today that's going to be paid at the maturity date. You can choose to sell the future before the maturity, but if you wait until maturity, then it's yours.
So that's what happened with.
And what a buyer of a future wants is for the price of the underlying assets that could be cautious or Tesla stock or oil. The buyer wants it to grow, to increase. So when you get the future, you can sell. You buy it for the fixed price that you decided 3 months ago, and in 3 months or now today you pay, for example, 100, but the price has in 3 months increased to 130. Then you have this profit of $30, example, that you make, and then you can sell it for 130, and you gain from it. So basically, an option works kind of similar, but there's some things that are a bit different. Is that you have this premium, so it works just as a forward or future that you go into a contract today, but you buying the underlying asset in like 3 or 6 months or 1 year, whatever. But for an option today, when you go into the contract, you have to pay a premium. So it can be, for example, $5. That if you buy an option in like Tesla stock, that has a maturity date of 3 months. You wait for the next 3 months. You have already paid $5. The Tesla stock, let's say it's worth, just so to make it basic, it's worth 100. And you have decided to, in the contract, to in 3 months you're gonna pay 100 for it plus this premium, so it's 15. In order for you to make a profit in 3 months, the Tesla stock has to increase above 105. Then you're gonna exercise the option,
because you can buy it for a cheaper price and then what it is at that moment.
Exactly, and then sell it for the value, for the real value of the stock.
Okay.
But if it's not above 105, then you just don't exercise. You let it just die, and the only loss you made is $5.
Exactly. Similarly, it would work similarly with put option, but it's like a contract. It's like you buy this contract and wait till hopefully for you the price is like low, and you have it's the right to sell it for a high price. So like if it goes low, you sell it for like a higher price than it is at that moment.
Exactly.
So that's where you get the profit from. And yeah, well, that can give you like, or it might be a little bit worse if you consider that in average the market should go up, but it also depends on the kind of stock.
Yeah,
if it's like a stock that has like a tendency to go down,
then it depends only on the value of cows. How good is it? How much milk produce?
Then one important thing that affects the options price is its volatility, right?
Sorry, one thing that
affects like the premium of the option.
Yeah,
volatility.
Yes, volatility.
Because the more volatile, or
volatility and how close to maturity date.
Exactly. Because the more volatile it is, technically it's like gonna be valued more because there's more chance to go more up or more down in the direction that you want.
The premium is gonna be a bit high. And
the thing with the maturity date, like you mentioned before, is that the closer to maturity, the lower its value, right?
The closer to maturity, depends on if it's a call or a put option.
Well, that's okay.
If it's a call option, where it's just the premium is gonna be lower if it's a call option and you're closer to maturity date. As you move closer, it's because there is less and less time for the option to grow, for the option to be more valuable, and for the stock to actually increase.
So basically, there's less time for the options to be volatile. Exactly, one of these volatile shocks.
Exactly.
Not only you can invest in not only other options in stocks that with I don't know, that are like underlying stocks, but there's also index options, right?
Yeah.
Basically, the index options give you it works the same thing, but like in the same way. But instead of receiving stocks or anything, they're gonna receive this money that is the return of an index. Exactly.
Yes. And an index, maybe we should describe what an index is.
Yeah, well, that's a good idea. So exactly what could we say that is an index?
An index could be like for example, S&P 500. That's like 500 most valuable companies.
Well, yeah,
Is it? Are they valuable? Or?
I think it is the most valuable.
Yeah, 500 most valuable companies, like in the American market.
So then we have the old
like 30. Yeah. So basically, you can have an index on the just that could be used as a benchmark that follows the price kind of whole market. You can have an index in a specific niche, like in technology stocks, and then they have maybe there's an index that invests in maybe like 50 or 30 technology stocks.
Basically, what it does is that it gives the average value of, for example, if the S&P 500 is like the average value of this like 500 most valuable stocks in the US.
Yes,
which can also work as a indicator for how the market is doing, right?
Yes. Yeah, so it's kind of a benchmark. Right? Yes. And that can also, it's not only that you can invest in indices, but also you can use it, like I said, like a benchmark to most often investors, investment banks and new funds, they want to overperform the market. But then they use an index that's kind of the same as their own portfolio. So, for example, a mutual fund that has like a fund in technology stocks, they're gonna follow a benchmark, an index with technology stocks, and then they want to overperform that benchmark, that index, in order to gain more profit and build more cool.
Yeah, I mean, because basically that's the job of a fund, like to overperform and for have people trusting their strategies, trusting their money into them. Because if not, what people could do instead would be to make their own portfolios that has a similar correlation to the market, and just like whenever the market gives, it's going to give you like similar returns.
Correctly.
Yeah.
When we speak now about these derivatives, when me and my partner, study partner Johan, we did the bachelor's thesis. So we wrote about Swedish equity funds and their use of financial derivatives, and it was quite, I wouldn't say impressive, but like shocking how little Swedish equity funds use derivatives. In comparison, for like example, for in the Canadian market or the American, even the Spanish market, we find some previous research on those markets that it was quite a difference. I had no idea. Yeah, like even Spanish market use much more. For example, there was this article, this research about the Canadian market, I think, or American maybe it was, during COVID outbreak, and they said, like, came with the numbers, how many we're using, derivatives for hedging purposes, amplifying exposures, inflation, and it was quite a lot. And they also found that hedgers were outperforming the ones that use derivatives for amplifying exposure and for non-users of derivatives when comparing different funds. So hedgers would save more money. And that was during the COVID outbreak. And when we looked at our statistics and what we found that only, I don't remember exactly the numbers, it was half a year ago, but it was about 14 out of 100 something, around 114 out of 100 Swedish equity funds that used derivatives. And out of those 14, it was only 6 that use derivatives where there is a value to it, where because these other ones, when they were using derivatives, it was almost to zero. So of course we found the non-significant results on how derivatives use affect the performance of Swedish equity funds. But we also found that users of financial derivatives have a higher, for example, trainer ratio than non-users. A trainer ratio is basically how high the return is in comparison to the own risk of the fund or the company. And they had higher trainer ratio. The users had a higher trainer ratio than the non-users. And it was quite shocking to see that no almost nobody uses derivatives in larger amounts.
What I was thinking? I was thinking that maybe because of that, especially here at university level, they're trying so badly to introduce us to financial derivatives. I mean, we've had it in courses, and they even get introduced to it in the most basic finance courses at university. Since Finance 1, you're already more about options, which I'm not sure in Spain. I don't know how the studies for for business administration in Spain are, but whenever I spoke with some friends, they barely know anything about financial derivatives. Maybe there's a relation to that they want to promote some generations financial derivatives.
I can see more and more on LinkedIn, people putting ads up about seminars on options and derivatives, Nasdaq doing it, which is great, and I love it, and it's really good.
There's one that is in a couple of weeks or 3 weeks, right?
Yeah,
Nasdaq officials,
yeah. I'm not gonna be able to be there, but unfortunately. What was it? It was
this in 3 weeks.
Is it 3 weeks or is it in the 2 weeks?
It's 3. I'm not sure how do you have them.
Maybe I can come. We'll see. But I'm gonna be overseas for 2 weeks.
Yeah, where are you going? Do you want to tell the regular?
So I am actually going to Bali, Indonesia, which I'm so much looking forward to. I have been there once before, when I studied in Singapore. Now I'm going actually again to just explore the nature, see the culture. Also another thing, I'm starting a new YouTube channel about some background. I've seen a lot of when I decided to go to Bali. I looked a lot on Instagram and like YouTube videos, and I saw all these influencers, travel bloggers, like a bunch of the same info, the same content. Where to go to, where to see waterfalls, where to go to restaurants, and all this. But I'm doing a kind of a different approach. So I'm gonna be blogging about investment opportunities and during travel. So it's gonna be a real interesting topic to share about.
Very interesting. So your project basically is gonna be like doing like this new vlogging camera style, but more finance focused. Yes, the finance focus, it could be said.
Yeah, like the travel, but finance focus, niche into finance, investments. And the name of my channel, by the way, to promote myself a little bit, it's gonna be Invest in Nomad without the G, because we already up G's, right? So Invest in Nomad.
Well, you'll soon be able to check it out. Invest in Nomad. It'll be a great channel
and great content.
Yeah. So that sounds great, actually. I guess we're gonna have to leave it around here. Unless you want to mention anything else. Follow Invest in Nomad. Follow subscribe, like, comment. And of course, I want to talk about vlogs for sure.
Follow, subscribe, like button on Albano Talks, and follow Instagram, TikTok, everything. This guy is the best.
In the background there. Well, thank you, Nicola, for coming. It was actually very nice. I was really looking forward for this episode, and speaking about the topic that I really like, and is finance, and what I want to study even more. And I think that you have given such a deep insight of financial derivatives.
I did my best. I hope.
Yeah, it was amazing, actually.
Yeah.
And I hope it goes good with your new project, and that it goes fast, and and it's quality content, of course.
Yeah, thank you. It's gonna do good. I hope so. And thank you for having me. I feel really honored. Again, it was really, really fun.
Well, thank you for coming.
It's always fun to talk about derivatives, finance, especially with you.
Well, and thank you for watching this podcast or listening to it in Spotify. And we'll see you in the next episode, either in Albano Talks in English or Español in Spanish. So have a great day, and goodbye.
Goodbye. Bye.